Hello, folks. Bill and Brian here with Energy Road. We're going to be talking a little bit about the market today, especially crude oil. So, Brian, I think it's time to roll the logo.
You got it.
Hey, folks, we actually are here. We had some time earlier this week to spend at the OEPA annual golf tournament and poker tournament. It was a good time to visit with all the producers there and get a little bit of their insight as well. And so, Brian, man, crude oil's going a little bit crazy. What do you think, bud?
Well, let's see. Well, first off, welcome. Thank you for tuning in. And if you have questions along the way, if you chat them, I believe in LinkedIn and YouTube, we can see them. Twitter, I don't think we can see them live. So little housekeeping, feel free to ask questions. We'll try and respond to them as we go. But yes, to answer your question, a lot's going on crude oil. And let's just take a look. Well, first, before we hop to crude oil, let's just take a quick look. Gas, this is representing because of the contract roll. October's up around 276, which is kind of what I projected for that close. And I projected 290 for the close. We extended a little bit beyond that. So let's take a look at crude oil. Lots happening there. And yesterday, as a result, or today, as a result of crude inventories coming out, the fact is that we are drawing from our commercial crude inventories. There's a lot of international implications when it comes to that. And one of the projections that we had, we put it on our live stream, was it 2 weeks ago or 3 weeks ago, that we targeted mid-90s, I believe.
I think, well, actually, we've been targeting mid-90s for quite a while, but we specifically talked about it 2 weeks ago.
Yep. So 2 weeks ago, and we did expect a minor pullback here, but it did not follow through. So I think this is a very bullish sign, and today's volume, there's a lot of volume behind this. So I think we are going to extend out, but we're really going to dive in deep on some of the fundamentals and really try and understand why are we up today. So if you have questions or whatnot, ask along the way. But let's take a look. First thing that we typically take a look at is we look at some of the managed money in the market, which is already in a long position, and they've got even longer. So if you look, they've built positions back from August 22nd to today, so roughly a month, and they've gone from 144,000 contracts to over 281. So the open interest on managed money, that means the hedge funds are believing that we're going to go up. Let's take a look at the contract. Currently, we're trading the November contract, and that November contract is going to trade until, what, the 20th of October, somewhere around there, Bill?
Yeah, should be coming up here shortly.
So the November contract is up above 90, and today's follow through is pushing us closer to that mark that we kind of had as the year-end exit, and we may have to revise that because that might look up. But we're going to talk a little bit about the fundamentals. But if you look, here's what's interesting: a year from now, we're projected to be at 78.87. I do not believe that number in the least. And 78.87 is what the forward market is trading for November of 2024. What do you think on that, Bill?
Yeah, that doesn't meet the fundamental demand we've been looking at. So I'm not sure what's causing that, other than that there's so many back and forth opinions on that demand, is that nobody knows what to do. And anytime you don't know what to do, it will drift downward.
Yeah. Well, and what we've seen on crude oil is the longer that you trade it, the more that it's kind of beat down. But let's take a look at some of the fundamentals. So some of the fundamentals, we're looking at a 12.9 million barrel a day production in the US. Now, I want to reference something, and that is that we're at 12.9 million barrels a day. That is a 0.8 million barrel a day increase. So this number right here, this production that we see is a 0.8 million barrel a day increase from the beginning of the year. We started the year, where did we start it? At 12.1 million barrels a day, and we've traveled all the way up to 12.9. So the US is 12.9. Now, do you know what our global demand is, Bill?
Global demand is always around 100 million barrels.
Yep. And OPEC, which is a great source of information when it comes to this. EIA has pretty good info, but OPEC has really good insight here. For year-end exit on world demand is around 102. So going back to what our production levels are looking like, 12.9, it's roughly 12 to 13% of the U.S. The global market.
Hey, go back to the OPEC chart for a second.
Yeah, because we're
So,
gonna dive in deeper on the OPEC chart. This is 2023. There is 2024, which we're gonna cover a little bit later.
so the way I see that, that would actually work out to closer to about 16, 17% of all the non-OPEC production. The U.S. production would be.
Yes, because you're looking at this number down here, right?
Yeah. Mm-hmm.
Yep. So the total non-OPEC liquids production, and this is part of the reason that many people see OPEC as the swing supplier. So this difference is what is posted out there, and usually this is the guidance of where OPEC starts to deliver. Now, one difference, if you are looking at OPEC's statistics, they have OPEC crude oil production, and they have OPEC NGL production. And for Energy Information Administration and on they combine those two numbers together. So when we take a look at today, we're at 34 million barrels a day. That means some of that, 28 million, roughly 28, 29 million is crude oil production, and 5 or 6 is going to be OPEC liquids. Is that right, Bill?
That's correct. The EIA uses NGLs and condensate in their. They consider that crude oil as in their crude oil number.
Yep.
So
let's
when even when you look at the production of the U.S., that production also includes, if I remember right, NGLs and condensate.
Yep. So let's kind of build backwards from here, which is going to be. I'm just going to open up this, and we're just going to do it as we talk on the call today. So if we have U.S. is at 12.9 million barrels a day, OPEC, and I'm going to count the liquids. We're going to count on them at 34, and Russia is the other variable. These are the three biggest supply areas that that drive exports. So all the developing nations and so on and so forth. Let me blow this up some. And if we take a look at 102, and we are going with percentages. There we go, and that's 12%. And then we got this as 33% and equals this divided by this. These into percentages. Where is the percent? Okay. So what you can see is 54% of the demand market is represented by these three suppliers. And this is why there's so much attention on OPEC and so much attention on shale in the US. And what part of the reason that we end up very bullish, or at least I do, is I think we are going to start Q1 closer to 12, closer to 12 million barrels a day, may sneak into 11.9. OPEC is a wild card, and Russia is another wild card. We're going to talk about some of the geopolitics here, but let's dive in a little deeper. Let's tackle this first variable on supply. Okay. When we look at crude oil production, we're currently at 12.9 million barrels a day. And folks that are watching live, feel free to ask questions. We will respond to them as they come in. Now, Bill, do you think in 5 months we are going to be at above 12.5 million barrels a day?
So when you say 5 months, so it depends on whether Russia and Saudi keep their barrels back. Our production will roughly be the same, but what they offer in supply for market may have a little change on that. That's sort of where I'm trying to figure out how to balance that between what they say they're going to do and what they actually do.
Yep. So one thing that we track very closely is we take a look at rigs and oil production in every particular basin in the United States. So we dive in deep on all of the U.S. market and when it comes to the supplies and demand. So every month on 12.8, 12.9 million barrels a day, we decline by over 600,000 barrels a day. That's without adding new production. So we decline by 600,000 barrels a day. And this is new production that we're bringing back online, which has dropped beneath that mark. So when we take a look at just the shale area, shale basins, we have gone into decline. And the August numbers are out. September numbers are probably going to be coming in about 20 days. I expect this to continue.
So, Brian, I think we need to use a different term there. What we said is we've got into negative territory. And what that means is that we're not producing over our decline. I don't want to use the term decline for two different things.
Yep. No, that's a good clarification, because what we track and have been monitoring is we take a look at the rigs, not just by total rigs in the United States, but also by which basin, which by the way, for those of you that are curious about Energy Rogue, we provide a platform. Let me increase this a little bit. We provide a platform with over 150 charts on energy fundamentals, technicals. We cover supply, demand, imports, exports, stocks for crude oil. Well, it's probably good if I show them this platform. Natural gas, NGLs, crude oil, refined products, electricity, rigs, maps. Everything in the United States market is contained within a subscription for $89 a month. In addition to the access to this platform, we do send out a weekly report, and in that report we have different price projections for the week, and we have different charts that are selected for crude, natural gas, and heating oil. Every day you would get an email that has over 20 charts a day. On Wednesdays, we cover NGLs. We also have a Discord channel, which for those of you that are watching, this continuation up is what we tracked out and posted this morning. So we post this on our Discord every morning, and well, that's our working right here. So did I miss anything on $89 a month?
No, I think you got everything. We got all of our. Oh, the other thing is that we also, for that price, if you have any questions that you'd like to talk to us personally, you can book a meeting with us.
Yep.
And that way you can actually get a specific question addressed.
And we do a energy market recap at the end of the week that we kind of cover in a video specifically for our customers. But let's get back to basics. So when we take a look at declines, all these rig declines, let's see, this is on weekly oil rigs in the United States on all the particular basins. In March, we were at 627 rigs. We're down to 552. That's a lot of rigs. And this is part of the reason that we're starting to see some of the declines overtake new production, because when rigs drop, new production is going to dissipate. It's going to drop.
So, Brian, go
Now,
back to that decline chart.
this one?
Yeah. So, folks, as we bring on new wells and they're bigger wells, they're going to decline faster. So, what you've seen here, as we've grown production, our decline curve has gotten bigger, and it will continue to do that because from day one, wells start declining. And so, what you're seeing is the decline will get bigger. We're at 600,000 barrels right now, but gosh, how long before we get to 700,000 barrels?
So we posted this on our website for our customers to kind of help them understand a little bit about declines. For the Wolfcamp, which is in the Permian, one of the more productive oil regions, a new well or an initial production is about 1,380 barrels a day. So what happens is it declines very quickly, and 12 months from now, it's only going to produce 217. So the more new production that we have, the more that we end up on a treadmill. And that's what Bill is trying to talk about. That is what is articulated in, this is a Permian natural gas example, but the premise is the same. If you start taking off new months where you are taking a look at, if you stop bringing on new wells, this is what happens. Let me click off these. Is if you stop drilling for new production, this is what happens to where you reach a cliff. So you're climbing, and if you're not bringing on new wells, if this example is for Permian natural gas production, so 19 BCF a day, and within, how quick is this? Let's see how fast it declines off. And within, let's see, this is February, 6 months later, you've lost over 3 BCF. So you went from 19 to below 16. So the premise is the same when you're looking at these declines. And that's part of the reason that when we look at shale oil production decline, our new production that we're bringing on is not enough to sustain or outproduce what we're already declining. And with dropping rigs, that means it's going to accelerate even that much more. So we're already seeing the shale oil fall into negative territory, and we expect this to continue and accelerate. And that's part of the reason that when I project year-end to exit, I mean, we're only talking about 3 months. I think we're going to be at 12 million barrels a day. There are many people that are projecting that we're going to continue to grow. I don't see that in the least.
We're not going to grow without some rigs coming on.
Yep.
Even with the efficiency of the rigs going up, they can't go. That efficiency can't go up enough to overcome that decline.
Yep. But when I look at OPEC, I think at best they would be at 36, probably more likely 35. And Russia is a wild card because as they enter the winter, I think this is going to be very fascinating to watch. But let's get back to the basics. When we're looking at demand, we have increased demand over 2023. Now, a lot of economists did not project this. A lot of economists projected that we were going to be in recession. There are some that argue we have been in recession. So we grew demand globally during hard economic times. So think about that for a second. If the economy is healthy, then we're going to have a very challenging supply portfolio. And that's part of the reason in 2024, let's see, Bill, I think our year-end exit, well, we'll hold in year-end exit in Q1 predictions for the end of the call, and we're
Okay.
gonna try and target maybe 15 more minutes. Do you think, Bill?
10 or 15.
10 or 15. All right. So when we take a look, this is OPEC's projections on global demand. Fourth quarter of 2023, they're expecting a full million barrels a day increase. A lot of that is because Chinese refineries and U.S. refineries are in turnaround season, and demand is going to pick up during the fourth quarter. It typically drops off in the first quarter. They're actually projecting that we're going to continue to see strong growth in 2024 and then moderate in Q2, which is some of the turnaround season, the spring turnarounds.
Yeah,
If you
but
look at,
also in demand, Brian, there's two new refineries, one really large refinery in Nigeria coming on. That's about 650,000 barrels and about 350,000 barrels in Mexico. So that's going to increase your demand by nearly 1 million barrels in 2024.
okay, and those must come on in Q3 and Q4 because
I think so. Yeah.
look at the jump here. We go from 102 all the way up to 105, and yes, OPEC wants higher prices, but they have a very good and a very good prediction mechanism in their data, and they don't seem to have too much skew to their data from what I've seen. So they're some of the strongest predictors I have seen on this demand side. So we're expecting OPEC to come back up. Currently, OPEC production is about 28, and they're projecting that our demand requirements, or the difference between demand and supply, is gonna precipitate in about 30. So so I think our demand is set for growth. Now, what I want to consider is we're looking at potential recession and hard times in Europe, Germany. There's talks that Germany may already be in recession, and then much of Europe, with the exception of France, may be entering harder economic times. But there's also projections that as much as their hard times are going to impact oil demand, Asia is going to pick up the slack. What are your thoughts on that, Bill?
Well, I think you can't rule out India either. They're probably the biggest opportunity for, let me say this, rephrase that. We're probably the most overlooked opportunity for increased demand because they're growing pretty quick, and they need energy to grow.
Yep. So let's start recapping a bit. So let's take a look at the basics. When we look at crude oil from the supply demand in the United States, we had 12.9 million barrels a day. Our imports were 6.5 million barrels a day because a lot of our refining inputs, which are 16 million barrels a day, require different type of barrels than the barrels that we import. Is that right, Bill?
Yes. It's really sort of a catch-22 because when you start including refined products as part of this, you have to realize we're probably importing some gasoline as well to meet the demand in the U.S.
Right.
And so, but also what we produce is a lighter crude oil, and it's harder for the older refineries to refine that. Some of the newer ones are doing pretty good with it, but and some of them have improved their refinery to where they can handle it. but we still export a lot of it because their refiners overseas are easier to do that, and they go and refine it and then produce it into gasoline and diesel.
Yep. So when we
And,
take a
and some
look
of
at
our exports are as diesel as well.
Yep. So when we take a look at crude oil production, obviously that's been a growth story since the beginning of the year. Um, and then our net crude imports, let's actually zoom this in a little bit. That looks very volatile. Our
Yeah, it's
crude,
crazy volatility. Yeah.
yeah, our crude imports swing week to week. August 4th, we imported 4.3, the following week, 2.5. So that's where we see a lot of volatility. OPEC supplies down and rig count down. Oil production is starting to flatten. Let's take a look at this right there. You can already start to see it's starting to flatten, and that's because of that base decline
Right. And
is
lack of rigs.
more. Yes, this base decline right here and lack of rigs is resulting in declines coming off. And this is what we've been tracking and expecting for months. And that's part of the reason that we've seen this drop off. So if you want to know a little bit more about supply side or learn a little bit more about Rogue Edge, there's links down below. You can book a meeting if you're curious about it. But let's flip over to the demand side, which we're kind of looking at. Well, let's look at stocks. So crude stocks, 769 versus a 5-year minimum of 857. That's on the low side. Commercial stocks are a little above the 5-year minimum. We typically try and take a look at not just the crude commercial crude stocks, but we take a look at everything. Crude and products total stocks, we're still at the 5-year minimums. We're setting new 5-year minimums right now. And this past week we did grow. So crude oil stocks declined, but we actually.
So I think what you have to realize is when we start getting down in that lower range, the price volatility gets to be pretty crazy on not just base crude oil, but also on any of your refined products as well, like on your diesel product as well.
So if you look
So
if you look globally, US is on the low end, floating storage is on the low end, Europe is on the low end for stocks. China and Asia is a little healthier, as well as Russia. So one of the interesting things is as we move into 2024, I think that sets up some very fascinating potential dynamics with Saudi Arabia, with Russia. We're not going to get too much into geopolitics because we'd be here all day, but that sets up some interesting things. United States in 2024 has a presidential election. Saudi Arabia has been starting to sell some of their crude not on the dollar. Is that right, Bill?
that's right. They just worked out a deal with China, I believe. But I can't remember what the size of the deal is, but it was pretty significant.
Yep. So that gets into the currency, US dollar versus crude, and what that relationship looks like, because we all
But
look at dollars for crude oil.
right, they also just did a deal with India and rupees.
Yep.
So
So Saudi Arabia has a unique interest on what crude oil is priced in, and there's some pressure on the US dollar as a result of that. China and Russia have some fascinating inner workings because China has increased some of their stocks. And what did they fill it with? Probably crude oil from Russia and Venezuela. And Iran, probably. And that sets up some interesting dynamics when we come into 2024.
hey,
And I
Brian, we
think,
got Austin has a question regarding what impact will the Russian diesel export ban have on refinery turnaround? Seems like
oh,
U.S. refineries may try to delay shutdowns in order to increase diesel production.
Let's take a look at distillate stocks real quick. Austin, thanks for chiming in. Let's take a look at I got to go to the refined products side, don't I? Fundamentals, and let's take a look. So gasoline is on the 5-year lows. Distillate is on the 5-year lows. So Austin, I think you're right. Refineries are going to try to do the minimum on their turnarounds, and
So what that means also right now is refinery turnarounds are their highest they've been in a long time. And
yep.
so they're making good money as refineries. So they're going to try to operate as long as they can with those kind of margins. Diesel ban on Russia, I'm getting a little, that doesn't mean they're not going to sell it, because some of the stuff that we've been banning there hasn't really stopped them from selling to other people like China.
Well,
so we could be playing a little shuffle here about where the diesel comes from. But when you do that, then you end up with transportation costs, which will run the price of diesel up.
Or said a different way, Austin, is you can take a look at Iran production that has been under sanction, and they've continued to increase, which indicates that those barrels are finding markets. It's not because Iran is consuming more. They're finding markets. They're going to different places that aren't within the sanctions. For example, that diesel export is one of the reasons that the China stock increase is expected to have some of this diesel as a result of it, because they can buy it cheaper from Russia. So that's what I do think the diesel export is probably going to be a shorter term thing, because both EU and the United States are really going to get punished the longer that is in place. So Austin, I hope that answers your question.
And we actually burn most of our diesel here. What we do is we'll send it overseas when the price gets high enough, and we basically trade that for unleaded gasoline. It's part of the imports coming in. But yeah, I would say that there is we could begin to see the correlation between crude oil price and diesel price begin to tighten even a little bit more. So I think I said that right. In other words, the variance is not going to be as big. So anyway, I think that helps you.
Yep. So this was Austin's question, and Austin, I replied to this. I think it goes to the YouTube to reply to this. But if that doesn't answer your question, or you want to talk a little bit more, reach out to us, rogue@energyrogue.com, and we'd be happy to talk to you a little bit more specifically about that. But I do think that diesel ban is a variable at play, and that's why when we get back to this equation, I think the fundamentals are set very bullish. We have continued all the way up from 77 to 93. There is going to be probably some softening in the market. I'm still cautious of a retracement down to the mid 80s, which I think is very possible. But the way this, when we are going up, it is with a lot of volume, and as a result of that, I think OPEC might be onto something, that our demand is going to continue to increase into 2024. Q1, I'm not sure I believe the Q1 number. I think we're going to be a little softer, so we might not shoot up as much as that is. I'd probably flip-flop their Q1 and Q2 projections and kind of have a stair step, because Q1 is typically a softer demand period, right, Bill?
Yeah, I think though there's probably what they're doing is sort of discounting any recession talk. I think they're talking about there's going to be some pretty significant growth in 2024. And if you haven't looked up the line, just look up that. It's an interesting project that's going on in Saudi Arabia right now, where they're building this mega city.
You said Line?
Line, the line.
Okay, the line.
And they're constructing this thing, and gosh, I can't believe it. I don't remember how many miles or kilometers long it is, but it's not short, where they're concentrating everybody into one part. And the construction on that, they're burning a lot of diesel over there right now with construction equipment.
Yep. No, that makes sense. And tell you what, in the next 5 minutes, we're probably going to recap. If you have any questions, Austin, thanks again for asking your question. If you have any questions, shoot them out because we will, after wrap up, we will answer any questions that come. But probably if we don't receive any questions in the next 5 minutes, we'll probably go ahead and shut it down. So I think
we still have to answer the question about when we're going to see $100.
Well, that's going to be part of our summary. So when we take a look at year-end exit, what is your year-end exit number? So we would be on the January contract. Well, no, we'd be at the February contract for
Right.
year-end exit. And currently the February contract, let's go back to our dashboard. And let's take a look at what the February contract is trading right now. February is trading 85.71. So the February contract would be the year-end exit. What do you expect there?
Well, I think that's wrong.
I 100% agree.
I think we'll still be in the mid 90s for the February. So let me rephrase this. In 2023, the last basically 10 days of December, just call it Christmas, I believe the February contract will be pushing 99.
Okay.
Now, as we go through January, it might soften a little, but I think we're going to be flirting with that $100 number at the end of the year, which I guess if I believe that as much as I would, I'd be buying it right now.
Right. Right.
So
no, that makes sense. And so essentially the February contract is likely to go up by, I'm a little softer than that. I'm mid 90s. So currently our prompt month, which is trading for what is it? The November contract is at 93.86, and I expect this contract, the 85.71, I expect that to be mid 90s. So we've got a band of 95, bills a little higher at 99. I do think Q1 we're going to see $100, but we're probably going to bounce up and down. And then by summertime period, I'm expecting a firm increase in that because we're going to start to feel more declines. I mean, we're at the $90 level and we're not seeing increases in rigs in the United States. That tells me that the marginal costs to increase in the capital discipline of producers in the United States aren't going to respond to, yay, we're at 80. So we're going to need more dollars underneath this because the cost of inflation has rolled through to rigs, it's service companies, operating costs, everything. So I think we're going to need at minimum 95, and I'm not bending off my bullish bent, and I would say 120 is probable by I'm going to say by May.
okay,
May of
so you're
next
going
year.
for the second quarter.
Yeah.
All right.
I'm gonna go a little aggressive.
You heard it here first, folks. Brian is going aggressive on $120 on the futures contracts in the physical first quarter of the year. I know that's
so year-end exit.
That's a lot of qualifying criteria.
So year-end exit, and we're not financial advisors. We analyze the market. We do offer our platform, which is $89 a month, which if you have interest, there's information down below. Book a meeting. You get access to 150 charts on supply, demand, imports, exports, everything that you want to know about crude oil, natural gas liquids, refined products, electricity, rigs, maps, the entire grid in the United States is covered in our platform for $89 a month. Plus, you get access to our Discord and you get access to us. You can reach out to us, ask a particular question. So that's our platform. I want to hear what you think the year-end values are going to be and the Q1 and Q2 into 2020.
So I think we're going to be at 99. We're going to see a 99 close,
Okay.
daily close,
Yep.
by December 31 on a current contract.
Okay.
Okay.
So I think a 99 close. I'm probably 95, 96. 95 is my number, but 96 I can see a close, but I'm not quite as bullish as you.
Well, I'll even go crazier than that. 99.27, and those of you who know me will understand the 27.
So that's our year-end number. What is your into 2024? I chose May.
Okay, you chose May. I'm gonna say by end of second quarter, so June 30th, I think we will see a 125 close, a daily close on a current contract by June 30th, 2024.
Okay. And so you heard it there, in the 120s for next year. That doesn't mean the high mark. Bear in mind, we're reserving the rest of the summer. Yeah, so if you want to talk about our high mark, we are going to cover that in our weekly Rogue Edge video. You can join down below. And listen, if you've enjoyed this, if you've learned anything, comment, like, share. It really helps us. I really appreciate you tuning in and watching. So 95 and 99 for year-end exit, and 120 and 125 by May or June.
99.27.
99.27. So listen, folks, I really appreciate y'all tuning in. If you have any questions, you can reach out to us. You can email us directly, and you can email us at rogue@energyrogue.com. Bill and I are here to help you on your mission. And our product, Rogue Edge, $89 a month. If you have interest, there's information down below, or reach out to us. So
and our goal is to make you successful.
Yes.
Not so much worried about your company, but we want you to be successful.
Yes. So thanks so much for tuning in, folks, and we will see you next week.
Let's roll the logo, Brian.
Did you know that people that sign up also get a free t-shirt?
No, I didn't. So we ought to get them a t-shirt. So if you're still listening, sign up and get a t-shirt.
All right. Thanks, folks.